What's up everyone, it's Scotty with Money Vesting. Today we are going to be talking about Palo Alto Networks, ticker symbol PANW. They are going to be reporting earnings next week for their third quarter of fiscal year 2023. So they are on a little bit of a different time scale, or in other words, different quarters are being reported as opposed to other companies like Nvidia, AMD, all those companies. But in this video, I'm going to break down everything you need to know prior to the numbers coming out. And they are going to be reporting, like I said, on Tuesday, May 23rd, after the markets close. So I hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. There is going to be a 16% discount on an annual basis. That is available, I think, by the end till the end of this month. So, and the 40% discount on the fundamental and technical analysis courses. That's the bundle that you can access as well. So both links are going to be down below. So first things first, let's talk a little bit about their results so far. And in the second quarter, they reported over $2 billion in billings, which was up 26% year over year. And RPO, which is the remaining performance obligation, was up 39% to over $8.8 billion, with overall revenues coming in at just over $1.6 billion, another 26% growth, and $2.33 billion in average or annual recurring revenue, up 63% year over year. So bottom line is, I think Palo Alto Network, along with Fortinet and CrowdStrike and Zscaler, these are like some of the top quality cybersecurity companies. If I were to kind of rank them, which I have done in the past, I've done like a tier list of these cybersecurity companies. I would rank Fortinet at number one spot, and I think that would be a very, very tight battle between Palo Alto Networks, CrowdStrike, and then Zscaler. I'm super tired, by the way, so if I do fumble some words, I do apologize because I've only had like 6 hours of sleep in the last 2 days. So again, I do apologize. But yeah, between CrowdStrike, Zscaler, and Palo Alto Network, I think there is going to be a pretty tight match. But I do like Palo Alto Network a lot more because I think they've got a much better path towards profitability. So what they have really mentioned, and they are now moving towards profitability as well. So you'll notice that operating income was up 55%, $377 million. EPS was up $1.05, and adjusted free cash flow was $685 million, up 55%. And look at this, GAAP net income, GAAP profitable, net income is positive for trailing 12 months. So they are turning the corner towards profitability, and this year 2023 is expected to be the first full fiscal year where they are actually profitable. So 2023 guidance updates is that billings are going to be somewhere between 9.1 and 9.2 billion. The annual recurring revenue at 2.75 to 2.8 billion. Revenue expected at somewhere between 6.8 and 6.9 billion. Operating margins 21.5 to 22%. That's been upped from previous levels, previous guidance, and raising its adjusted free cash flow margin as well to over 36 to 37%. The company's been very, very consistent. So again, RPOs have been consistently growing 39 to 40%. Next gen security ARR, that's your annual recurring revenue, also growing in a very nice substantial manner. And total billings have been a little bit more flat. It's more cyclical too, like Q4 is the best quarter for the company, and it kind of drops down in Q1. And revenue has also been on a consistent increase. You can see over here, going from just under $400 million to over $5.5 billion, and trailing 12 months sitting at over $6.1 billion as well. Gross profit has also grown consistently, but of course operating expenses have been pretty high, and as a result the company's not been profitable. However, on a trailing 12-month basis, they are now slowly and steadily approaching that profitability, right? So $23 million on a trailing 12-month basis, which is still not a lot, I get it, but it is a good starting point, right? If the company can actually adjust its operating expenses and do some cost control, then they are eventually going to turn the corner. And that's obviously that institutional money can be very excited about this company moving forward. This right here is the non-GAAP earnings per share, which, by the way, on a non-GAAP basis, they are profitable, and 81% growth here to $1.05 per share, and then adjusted non-GAAP free cash flow at over $2.7 billion, and that was also up 76% on a year-over-year basis. Q3 and Q4 guidance, again, 22-25%, and then for Q4, 16 to 18%. So you can see the growth rates are slowing down a little bit because the company is getting bigger and bigger, and total revenue also expected to grow between 22-24% and then 25-27%. So they are able to still manage that plus 20% growth in overall revenue. And of course, EPS non-GAAP at over 50 to 57% growth and 40 to 53% growth in a year-over-year basis in the fourth quarter as well. So in terms of the balance sheet, now this is the only thing that kind of concerns me a little bit, which is the cash is at 3.3 billion and total debts over 4 almost $4 billion. So net debt sitting at just over $607 million for the company. So they do have less cash than debt on the balance sheet, which is by a small amount. It's not a huge deal, but it's something definitely to be watching. And the current and quick ratio are also really bad for the company. So they are most likely going to be raising some capital here in the near term because of the liabilities that they have on the current account in their balance sheet. So they want to be able to service that. So I think a capital raise is going to be on the way for Palo Alto Networks fairly soon, either through equity or through debt. This right here are the profit margins, so almost 70% margins here. We got free cash flow margins at 35% with some decent margins for EBITDA, net income, and return on capital assets and equity is pretty low right now at the moment. This right here is going to be the valuation. So again, valuation is still pretty high on a GAAP basis. A non-GAAP basis trading at a little bit over 47. GAAP basis extremely high because of the very, very low earnings per share. But eventually, of course, as economies of scale kicks in, as they do a lot of cost control, I think that GAAP EPS can start to move up in a very, very significant manner, similar to what happened with Tesla, right? Eventually, this P multiple came down, and that's what we're going to see. We're going to see multiple compression here for Palo Alto Networks over time as earnings grow. Price to sales, we're trading at a little bit over 8 to 9. Enterprise value to EBITDA at a little bit over 32 right now on a forward basis, and then price to cash flow trading at just over 20 to 22. This right here is the actual net liquidation value, which is negative because the company, like I said, has more debt than cash on the balance sheet. It's also got more liabilities than the actual total assets that can be sold for some value. So $5.3 billion negative is what their net liquidation value is. So we can just ignore that. And this right here is the actual growth rate expected from analysts. So $4 expected all the way to grow to $9 by 2027. If you plug those numbers in, we're looking at a 22% CAGR, a little bit under 23% compounded annual growth rate for this company. And the share dilution has been a pretty significant aspect as well, almost 5% per year since 2013. So the share count has gone from 206 million to over 316 million shares as of the time of this video. So going over to some of the analysis here. So by 2023, I think the net income estimate is going to be 1.2 billion on 316 million share count. Is going to be EPS sitting just under $4, right? That's exactly what analysts are also forecasting for this year. And for growth rate, I'm not going to go, well, you know what, maybe I could go 22.5%, but I'm going to be on the safe side. Let's just go 20% growth for net income for Palo Alto Networks. And I'm going to go with a little bit of a higher P multiple, right? 25, because that growth rate is decent. And then, of course, we got to put in the 4.88% share dilution, which is going to be roughly around, I'll just put 5% here, and the fair value drops down to under $100 per share. I don't even know where it's trading right now. This is literally me going over, okay, 188. So $180 is where it's at the moment, which means that it would need to pretty much get cut in half, 47%, for it to actually make sense. Now, of course, you can go with some different analysis. You can go with sensitivity grid here. You can look at different P multiples, different growth rates to kind of figure that out for yourself and see, whether the stock is worth the value right now based on different growth rates and different P multiples. For example, at 20% growth rate and a 33 times P multiple, it's probably already trading at its fair value at close to 190. But that's what the market's pricing in, right? 28% growth for net income, which actually might be possible, and then a 35 times P multiple, which is a little bit on the higher side, but hey, that's what growth stocks demand, right? They demand a higher multiple, but that doesn't leave a lot of room for multiple expansion, only more room for multiple compression. So hope you guys enjoyed this video. Let me know in the comment section below, what do you think about this Palo Alto Networks? And we've got a resistance that we need to watch for. All the way over here, that's sitting roughly at $202. Earnings are going to be quite interesting, and right now we're really just trading sideways. And if it does end up selling off, again, 133 is going to be that support level. It has rallied quite a bit from its January lows. So in the last few months since the year began, year to date, it's up over 33%. But I think I would be a lot more interested around here. I think this is exactly where my fair value was last time I also analyzed this company. That's going to be in line with this support from back in March of 21. So also in line with that 300 simple moving average. So those are some levels that I'm really paying attention to right now. And again, let me know your thoughts down in the comment section below. Resistance is going to stay put roughly at $201. And of course, my buy price is going to be 50% lower from that at close to $98. So again, hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. Remember, 16% discount that's available till the end of this year or end of this month. And as always, happy investing, and I'll see you all in the next video.